Excellent. Thank you and good evening, everyone, for joining us on this week's speaker series. I'm happy to be joined today by James Johnstone. James, good evening to you. I know you're reaching us from London.
Good evening. Yes, thank you very much for having me on. It's a very cold and chilly London here. Much rather be in Florida, but it's great to be talking to you tonight.
Excellent. Thank you for joining us. So just to introduce you, James, a bit to the field, James is a portfolio manager for both a frontier market strategy over at Redwheel and also a sort of a blend emerging market frontier strategy as well. Is that correct, James?
That's right. Yes, we have an emerging market strategy with a significant frontier exposure, and also I run dedicated frontier strategies too.
Excellent, James. So I think that's a great place to start. Why don't we let our audience know, how do you define internally there, Redwheel? What is a frontier market? What is an emerging market? These designations, what kind of rubric do you use to designate them?
So we take the MSCI indications on the whole. Obviously, the classifications of MSCI for emerging markets have been pretty static for quite some time. The last promotion up was actually Israel. We've seen Greece come back into the emerging market universe. For frontier markets, again, we take some MSCI definitions, but we've got a much wider definition. Internally, we really look at kind of around the $2,000 per capita GDP level as being the defining characteristic of a frontier market. And obviously, we're looking for those markets which are successful to make that transition to being emerging markets as they move through the $2,000 level up towards the $5,000, then ultimately to the $10,000 level. So it's a pretty generic definition on the emerging market side, but frontier, we take a much wider approach than many of the index providers to give us a much bigger universe.
Right. And so that third hybrid group, let's say, or that in between, that liminal group, it's sort of, I think you defined it earlier, like in our conversation, as the next up, right? Or the next generation.
So, obviously, since our friend Jim O'Neill termed BRIC, people are always trying to come up with the next acronym. I kind of use BTIC as the ones that I classify as big emerging markets. So Brazil, Taiwan, India, China, and Korea really have all the definitions and all the characteristics of now being very developed emerging markets and very big and liquid markets. So we take some of the smaller markets in the ASEAN region, so Thailand, Indonesia, the Philippines, countries like Chile and Peru in South America, markets which have really been overlooked by the index over the last 10 years. And the growth of the Chinese capital markets, the domination of Samsung and TSMC, the market really hasn't kept up to date with the opportunities available. So if you were to buy emerging markets passively, which obviously we would never recommend, about 80% of your exposure is going to be based in those big five markets. And we think there are a lot of opportunities in the smaller markets which have been overlooked in the last 10 years. So we're very positive on places like the Philippines, for example, today, and Indonesia, overlooked markets, under-researched markets, and substantially under-owned markets.
Yeah, I tend to agree with you on that. The broad brushstroke of emerging markets, I think it's a bit outdated and really sort of fails to capture the true differentiation between some of these markets. And like you said, many of them are extremely different paradigms, stages of growth, stages of development. So you definitely want to be more surgical, I guess, in how you invest in these. Now, James, you began your career over at Schroders many years ago. Sort of in the nascent emerging market period, like you mentioned, right? Sort of when China really kind of entered the World Trade Organization, a massive deflationary force around the world, 1.2 billion Chinese laborers now entering the global labor pool. That was, China's biggest export for 20, 30 years was deflation. Now we're in a different environment. How do you see, how is that landscape fundamentally different than the one we're currently in, or is it different?
It's a great question. I think people are going to look back at the last 30 years and obviously the seismic geopolitical change, as you say, was the rise of China. What really happened, I suppose, in 1989 was you had that huge confluence events, the end of the Cold War, the fall of the Berlin Wall, the opening up of China under Deng Xiaoping, and really India coming back into the global market. That unleashed, as you say, 2.5, 3 billion people into the global workforce. And that solved the problems that the developed markets had post the 70s and 80s of cheap goods, cheap labor, and cheap energy. The world in the last couple of years has just suddenly realized they've run out of all three things. We've run out of cheap goods, we've run out of cheap labor, and we suddenly ran out of cheap energy, accentuated by the fact that we're trying to make this transition to a green economy, and Putin invaded the Ukraine. What's going to solve for cheap goods, cheap labor? It has to be the next generation and the frontier markets. We're going to have to utilize the 200 million people in Pakistan, the 200 million people in Bangladesh, the 100 million people in Vietnam. They have to be the next generation of workers. And what's incredibly exciting is China today, as you said, has exploited deflation for such a long time. China now faces its own demographic issues. Right. As you saw in the press last week, China recorded its first decline in its population since the early 70s. China needs to get rich before it gets old. And so as China begins to loosen some of its hold on global manufacturing, China moved from 3% of global manufacturing to 26% of global manufacturing. What people don't really understand about deglobalization, it's not just the West that needs to build factories in Vietnam, in Bangladesh, in Mexico, in Romania, in Morocco, in Egypt. The Chinese companies want to move their capital to those countries in search of cheaper labor. So really the world faces this big, as you say, inflationary pressure from a lack of workers. We're either going to solve that by bringing in the next 2 billion people, the next generation of workforce into the market, or there's an argument that we reshore, we have robotics, we have AI. We don't think that the technology is in place yet to really solve that equation. We think reshoring will happen, but what's going to be inflationary for the West, manufacturing companies are going to have to build 3 lines, one in Mexico, one in Vietnam, one in Bangladesh, to replace one massive line in China. That's inflationary, that's highly capex intensive for the Western companies. Industrial margins will come under pressure, but it's wonderful FDI for the countries that are recipients of this FDI, because that manufacturing, that workforce, that labor growth, which leads to consumption, we should see a repeat of those amazing 30 years, as you say, in the economies like China, Korea, Taiwan, even Thailand. So we're looking to kind of follow a well-trodden path to growth. We've seen this before. This was the US in the 1870s. This was Japan and Korea in the 1950s. This was Hong Kong in the 70s. This is the Southeast Asian markets in the 80s and 90s. China, as you say, for the 20s. We're looking to replay that next growth wave in employment.
Right. So James, one more point on sort of this macro level before we get into more immediate concerns for this year and perhaps more like idiosyncratic factors. Are these countries as well positioned as the BRICS were 20, 30 years ago to provide the cheap labor, to provide the cheap these cheap factors of productions for these Western and Chinese and North Asian countries that are, because it's not just China, it's also Japan that has a terrible demographic problem as well. Europe in general, we've seen some of that here in the US. Are these, let's say, these next up countries, these frontier / next generation countries that you're looking at very specifically, are they ready from a regulatory framework? Are they ready from do they have the legal infrastructures, the capital controls, the type of infrastructure in place that at least 20, 30 years ago allowed all this capital to flow out of the developed world into the emerging markets? Are they ready?
Yeah, that's obviously the $1 million question. We look for, as you say, those specific late stages of infrastructure and growth. Do you have the institutional positioning? Do you have a rule of law? Do you have a government that's interested in developing a country, or do you have a government that wants to steal money and put it in offshore jurisdictions? We look at education levels, we look at demographic levels, look at education levels, look at electrification levels. All of these things have to be in place. China had this incredible workforce, and as they moved 700 million people out of the agrarian situation across the kind of hinterland and moved them into the eastern seaboard, you had this incredible workforce that was ready to go. Not all of these countries will be winners. There's some of these countries, unfortunately, take up the wrong direction. Myanmar, Burma was an amazing economic power in the 1960s that massively overshadowed Singapore, for example. But unfortunately, the government took it in the wrong direction. You could point to Zimbabwe, you can point to Venezuela as countries that were used to be big parts of the economic industry. Venezuela was 5% of the index when I started, and unfortunately went in the wrong direction. But we have to pick those winners. Whether it's going to be Vietnam, which is the new replacement, the new workforce for the world, that looks very exciting. Samsung Electronics has now moved almost its entire production. You'll have seen that Apple are making their AirPods for the first time in Vietnam. So you are seeing the signs that Vietnam is beginning to prove itself as the ability. No one's going to replace China. China's got too big a stranglehold and too big a global impetus to manufacturing, such a concentration of cluster effects, such a huge, highly talented workforce. It's going to be very hard. But it's just these little fragments which come out of China and move, as you say, to Mexico and to Vietnam. That's transformational for these much, much smaller economies. So we think there are some countries which are doing really well. Bangladesh, for example, there's already 6 million people who work in the ready-made garment factory. My trick when I used to live in Miami with my children at the time, who were 5 and 6 at the time, you go into Gap and find me some clothing that's not made in China. And I'll give you $1 if you can bring me a T-shirt that was made in Bangladesh or Pakistan. You try that game today with your children, you're going to be very poor at the end of your shopping trip to Gap, because you'll find on the back of that T-shirt, made in Pakistan, made in Bangladesh, made in Vietnam. China doesn't want to make T-shirts. China can't afford to make T-shirts anymore. And so we're beginning to see some countries emerge. We need to pick the winner. We think that Vietnam is really making some great strides. We think Bangladesh has got a great chance. Morocco will make more cars this year than France. Romania will make more cars this year than Italy. It's already happening. We've seen it before. Poland has been an incredible success story. We think Romania could be the next Poland. We think Egypt has a fantastic opportunity as well, given its geographic location, and you cut those supply chains. So there'll be losers. It's always very sad, but some countries do go the wrong direction. But as you say, we need to find the political regime that works well. We need to find the structure, the regulatory regimes, the institutional strength, and the workforce. And that all needs to come together. And then we should find some big success stories over the next 20 years.
Excellent. So, James, let's you mentioned China. Obviously, it's a world's second largest economy, very important, big driver of global growth. We started the year here with a house view that China would be the best performing economy and the best performing market for 2023. So far, so good. It's still early. That's sort of our tactical view. Our longer term strategic view on China is a bit more bearish, but I'm curious to hear what are your sort of tactical and strategic views on the Chinese market, being that it's such an important component of the emerging markets?
Yeah, I mean, I think no conversation about global macro or global markets cannot talk about China. China's become such an important part of the whole global economy. Our view was very much, you always have to listen to Beijing. Beijing is very clear at telling you what they want to happen. So if you go back to the end of 2020, when Beijing pulled the Ant Financial deal, there was a pretty clear message from Beijing that they had the technology sector in their sights. There was regulatory pressure picking up on some of the big internet giants. And you have to listen to Beijing. For the last 30 years, Beijing's really told you where they want your capital to be allocated, be it through electricity utilities in the early 2000s, be it through renewable energy in 2010s. So Beijing told you there was a bit of a regulatory problem coming, especially in the education sector, which we all remember in Q1 21. We felt that was beginning to change in late 2022, coming into the party congress. Obviously, valuations are incredibly important. Everyone loved Alibaba as an $800 billion company. Everyone seemed to hate Alibaba as a $200 billion company. Our view was very much in a normalized capital market regulatory environment from Beijing. The right answer was somewhere in the middle. To your point, we didn't anticipate quite such a fast rollback of zero COVID. That was obviously forced upon Xi Jinping, probably a bit more aggressively than he would have liked due to domestic discontent. But therein lies the real excitement about China is that they have to deliver economic growth. If you are going to have a communist party, strict regulatory political control, the compact with the people is that we will then deliver you prosperity. You cannot have a declining economy. So we feel that China is going to have to be more stimulatory going forward. China was the only global central bank, major central bank, to be cutting rates. Let's not forget, China saved the world in 2008. Now, I made that mistake saying that in Miami last time. China and the US saved the world in 2008, but China was really at the heart of the financial monetary easing of the response to the global financial crisis.
Yep.
China didn't print anything in 2020 and 21. So China spent 10 years trying to reduce the bubble that it blew into its own economy after 2008. We feel that the West is going to spend a long time now trying to claw back the monetary response it made to COVID. So while the West is tightening, China should be loosening. So China's got this wonderful tailwind of a loosening monetary and fiscal policy. It's reopening. You've had an incredibly severe lockdown. I mean, it was a very tough lockdown, but we think there could be up to $5 trillion. That's the size of the German economy in excess savings within the Chinese population. That drives consumer discretionary. And the big conundrum is obviously China-Taiwan. Now, we have an interesting relationship with Rice Hadley Gates. So when Dr. Condoleezza Rice, when she left office, she set up a consultancy business. We spent a lot of time discussing geopolitics with her. Obviously, post the Ukrainian invasion, there was a big concern as to whether China was going to be investable. Every time we heard that there was another mandate for EMX China, it made us want to buy more China. We know that markets obviously over-respond. As I said, Alibaba at 800 billion was everyone's favorite stock. Alibaba at 200 billion apparently was uninvestable. So we've made the decision to go overweight China from a tactical basis in Q3, Q4 last year. As you say, luckily it's worked. The market's performed very well. Valuations aren't stretched. You're still only paying high teen multiples for some of these fantastic companies. There's a huge amount of stored up, pent up consumption to come through in China. So we think China's got a very good, at least 9 to 24 months ahead of it in terms of valuations, in terms of growth, return of earnings growth, and a very dramatic underpositioning for most people. There was a big disconnect between EM funds that liked India and EM funds that like China. We think India is very expensive. India trades at 130% market cap to GDP. And when you trade at that kind of premium, you can't have a problem. So this whole Adani issue that's come through, this causes a little bit of concern around whether you can maintain that premium valuation. So we still see that trade. People need to sell India to buy China from the international perspective, but we think that the Chinese domestic equities also look very attractive domestically. So, we're very positive on China from here. It's had a nice bounce. We think there's a reasonably good way to go from here as well. Longer term, there are big issues. China needs to decide whether it wants to be an international actor, a good actor on the international stage, and diffuse tensions around the Uyghurs, diffuse tensions around Taiwan, diffuse tensions in the South China Seas. We think, again, that will be partly driven onto Beijing by the requirement to keep the population in long-term prosperity accumulation. So we're quite positive on the long term. There are obviously issues which we're going to monitor very carefully, but definitely, to your point, short-term tactically, China looked very oversold, and Beijing basically said, okay, fine, the capital markets are back. We need the economy to work, and the regulatory pressures were taken off.
Well, I think they were taken aback by the scale of the protests. That was something really you really hadn't seen that since 1989, right? Since Tiananmen Square. So sort of longer term, we know these issues. We know Xi Jinping is not Deng Xiaoping. So there are important differences there, but perhaps that's a longer conversation. So let's move on, because otherwise we're going to be, we can talk about China for hours, right? It's so important. One last question on China, though, because this is something that I've been monitoring closely here, because we have such a bullish call on China for this year. I saw a headline the other day that worried me a bit. I'm wondering what your thoughts are on it. We heard that there were some rumblings within the U.S. Department of Defense and State Department at perhaps pursuing secondary sanctions against China for potentially aiding, in a very light manner, some of the Russian war effort. Do you see any risks of those secondary sanctions coming online or coming to fruition? this year?
Yeah, I mean, I think one of the most interesting aspects of this Thucydides trap that people talk about, the US versus China, the West, and obviously led by the US, the big element they have over China is semiconductors. China imports $750 billion of semiconductors a year. Without semiconductors, you can't do anything. As the Russians are finding out, they can't make cars with radios because they haven't got semiconductors. So while the West continues to apply gentle restrictions on technology imports into China, China has to, I think, has to agree with where the Americans want to drive the relationship, because they can't do anything without a homegrown semiconductor industry. Now, they've poured probably north of $1 trillion into building
It hasn't worked.
Then it hasn't worked.
Right.
So now that we've got TSMC building in Arizona, we've got Samsung building in the US as well. I think that lies at the heart of the relationship. We don't want the US administration to be too strong on China. We don't want to force them into a corner. But at the same time, we would imagine that they'll keep fairly tough restrictions. And again, this is all tied into the human rights aspects across some of China. We spend a lot of time making sure that the ESG credentials of the Chinese companies that we own are obviously incredibly stringent. But I think overall, the American administration also wants to make sure that China stays a good actor on the world stage, because it's such an important of global growth. If China decides to loosen and decides to stimulate, that's going to be an incredibly important offsetting part of the global growth picture to the kind of forced technical recession that many Western governments are being forced to move into to try and offset inflation. So the Goldilocks scenario, to your point, is that China is a good actor. China does understand that it can't push too badly across to the US, but in return, the US doesn't impose too dramatic a sanctions program onto China. So at the moment, we look good. I mean, the US administration wants growth. The China administration wants growth. We seem to have found a happy compromise. But as you say, it's definitely one to watch very carefully.
Excellent. James, we're unfortunately running out of time here, so let's do a quick jaunt around your universe. What are some of the, let's say, immediate places or regions that you're bullish on, and perhaps others that you're a little bit more cautious on?
So we are super bullish on commodities. We feel that the world has underinvested in commodities dramatically for the last decade. At the peak of the last cycle, that the BHPs, the Rios of this world, were spending 3 times in capex what they spend on dividends. They now spend twice in dividends what they spend on capex. There's been no exploration. If the world wants to decarbonize, it's incredibly metal intensive. The world, as a human race, we've used about 800 million tons of copper in the last 3,000 years. We're probably going to need to use the same amount of copper, 800 million tons, in the next 30 years. Now, the problem is we only produce 20 million tons of copper a year. So we're very excited about the potential uplift to commodity prices. If you look at commodity prices in real terms, copper peaked at $5 in 2012. It's at $4 today in 2022 money. That's the equivalent of still being down 50% in real terms. Copper's at the heart of everything we're going to do in terms of electrification. Electric vehicles use more copper, windmills use more copper, the grid needs upgrading. We haven't even started on Indian grid capex compared to Chinese grid capex. The world is going to be incredibly copper intensive. So we know that the demand picture looks strong. It's supply that's the issue. Peru and Chile are 35% of global copper supply. Both countries have got fairly difficult political backdrops to commodities at the moment. You've got obviously difficult situations in Peruvian politics. It's probably the only country in the world that's had more leaders than the UK's had in the last couple of years, which is saying something. We're on our third. But those kind of backdrops and headlines make it very difficult for capex to be invested. And the problem is also the grades are getting weaker. Codelco, which is the leading Chilean government copper producer, is going to spend north of $40 billion of cash flow over the next 5 years to keep production flat. So You've got copper looks very poorly supplied. The main supply growth will come through from countries like Indonesia and predominantly from the copper belt of Southern Africa. So we've got some super exciting investments in the Congo and in Zambia. But again, the copper belt really last saw its big amount of investment in the 1960s. So this again is coming back to difficult locations, difficult jurisdictions. And that's going to continue to put pressure on supply. So we're super bullish on commodities. Commodities normally translates into fantastic economic growth for emerging markets. Now, if you go back to 2002, the start of the last great brick rally, you bought emerging markets for commodity exposure. Today, that commodity exposure has to be found South America and Africa, in effect. So you're not getting that passively. Copper prices triple. That's not good for China. Oil prices go up 30%. That's not good for Korea. So we're very confident that you have to, as you said earlier, cast your net wider than what the index tells you to look at in emerging markets. And this commodity rally, both soft and hard, should be incredibly attractive for emerging markets. Brazil and Indonesia are the two obvious examples which have got everything. And you mentioned earlier Argentina. Argentina, like Chile, has got everything the world needs. We've been very successful in getting lithium right over the last couple of years. Argentina has got huge deposits of lithium. Some of the Lundin Group families have found incredible reserves of copper in Argentina. You've obviously got fantastic soft commodity exposure. We're waiting for the elections. It would be very interesting to see if Argentina becomes only the second kind of orthodox right-wing politics after the elections next year, obviously alongside President Lasso in Ecuador. But Argentina, especially with the Vaca Muerta, really producing an incredible amount of oil and gas, as was always promised, but maybe not have been expected. Argentina could be the real surprise story. And I realize I've probably got a lot of Argentinian specialists on the line, but we're quite excited by the potential rally as we saw 2014 to 2017, the last time Argentina had a very spectacular capital market appreciation.
Excellent. So now that you sort of brought it back here to the region, like there was a question that it said that, well, it sounds like Argentina, like that Latin America is out of the picture. Quite the contrary. You think as well that there are. Now, let me ask you this, because this is, and you sort of alluded to this a little bit here. We agree with you. I mean, we agree with a lot of things you just said. Number one, we definitely agree with you with the commodity super cycle. We think commodities could potentially be the best performing asset class of the next 10 years. And we agree with you on the fact that Latin America has the potential. I mean, it's difficult. It's hard to think of a better macro environment for Latin America than the one we're currently in, right? Not only if you buy our view here that we're in a commodity super cycle that's going to be extremely bullish for the region, and you're looking for Europe and the United States are looking for alternatives to Russia, right? So Latin America is a natural place to go or look to, but the political situation domestically looks iffy. It could ruin Latin America's moment, let's say, potentially. How do you view there? You've mentioned it a little bit, maybe just dig a little bit deeper into that, and then we can end with that.
Yeah, no, I mean, if you look at what central banks did across the world, Latin American central banks led the path. Brazil went from 2% to 14%. Chile went from 2 to 12. Central banks in Latin America took the initiative when they started to see the inflation spike. The UK were terribly excited. We've got ourselves to 4% interest rates. We still have 10% inflation. So right. We're still running at -6. So if you think about GDP and CPI baskets, the US, the UK, we're kind of fixated on dentist prices. It's all about services. EM GDP and CPI is all about stuff and goods deflation is coming through. That should lead to fantastic cuts in interest rates. If you look at the forward curve in Chile, for example, the forward curve's back at about 4%. That's 800 basis points of cuts to come through. Chilean domestic pension funds have never owned so little domestic Chilean equities. Chile has been an amazing country in exporting capital for 20 years, but it's left the Chilean stock market flat over a 20-year period in dollar terms. We've got property companies in Chile, which obviously derated dramatically with the rise in interest rates. You reverse the interest rate move, property prices go back up. So we're very excited by Chile. Chile, like Argentina, you've got lithium, you've got copper, you've got salmon, you've got wine. What more could you want for in life than the Chilean and the Argentinian products? They export stuff. It's not digital mining for nonsense Bitcoin. This is real stuff that the world really needs. And that's going to be found across South America. Brazil, Lula going to be the architect of the fantastic rally we saw in 2002 to 2008? Is he going to be good Lula? Is he going to be bad Lula? We're inclined to believe that he's going to be good Lula. We've had the initial volatility around independence of the central bank, fiscal programs. We would anticipate that the market would like good Lula, and rather like we saw in Mexico. Actually, the president hasn't done anything that was completely feared to happen in Mexico, and the Mexican markets performed incredibly well. And I mentioned Mexico several times. BMW just announced $1 billion plant in Mexico. They historically would always have put it in China, but they've decided to put it in Mexico because it's the obvious place to reshore closer to the big market of the US. So we're super excited by South America, but as you say, politics are difficult. You've got difficult politics in Peru. Colombia's not been easy. Chile's not been easy. Mexico and Brazil, as you say, the conversations about politics.
To be fair, we have difficult politics in the UK, in the United States, in Europe. There's difficult politics everywhere right now, right? So
exactly, and in those markets, you're paying 25 times earnings. In these markets, you're paying 5 times earnings. So I know much where I'd have my money, because politics is priced in. Exactly to your point, politics is priced in, and if we begin to get some interesting political reversals, possibly like maybe the return of an orthodox, mildly right-wing government in Argentina, that could be the start of an incredibly attractive cycle. We begin to see Lula make the same correct decisions he made in his last administration. We begin to see Mexico receiving FDI. Chile continues to benefit from commodity prices. There's a very, very positive picture for many parts of South America. And that would be obviously an incredibly important part of our portfolios going forward.
Right. Excellent. James, well, thank you so much. Unfortunately, we need to cut our conversation short. We're over our time limit, but it's been a real pleasure speaking to you. Thank you for joining us from London. I know it's quite late over there. I believe it's 10:30. Is that correct?
It's 9:30. So
9:30. Sorry, I missed it by an hour. It's a 5-hour difference. That's right. We haven't had daylight savings time here yet. So, well, again, thank you for joining us, and glad to see that Redwheel, and specifically that emerging market strategy, is now on the platform, and hopefully we can see you again sometime in the future and we can renew our conversation.
Yeah, my pleasure. Thank you very much indeed for your interest and your support.
Thank you. Take care. Bye-bye.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.